Hello traders, welcome to the Nexoel Trading Hub YouTube channel. In this video, we're going to have a quick review on last week's Forex forecast. To stay updated with the weekly Forex forecast, you can do well to subscribe to the YouTube channel and join the free Telegram community. So this particular review is going to look at the entries you would have actually considered during the week when the market opened on Monday through Friday, how you would have traded this setup that I actually forecasted and made available in the YouTube channel. So guys, let's head to the chart so that you can understand the perspective that you should actually look at the price delivery from and actually execute your trade. And the purpose of this in-depth review is actually because one of the subscribers actually reached out for this video to actually be done, for the entry models to actually be taken into perspective, how he would have actually executed a trade during the week based on the forecast that we gave. So what you can see here from the chart, this is actually the gold here from the weekly time frame. If you can remember last week, we saw the rate of this buy side liquidity. So I told us that we should expect the pullback of price to the downside, where price is going to mitigate this rate of buy side liquidity, and then we have price push to the upside. So this was last week candle, and then this was just the week that just ended, and then we see that price dropped to the downside, and then we had the push of price to the upside. But when we drop to a lower time frame, you would understand and see that the move of price to the downside down below this buy side liquidity level did not just happen immediately. So let's check the daily time frame. So here in the daily time frame, what we can see is the buy side liquidity resting here, and then you can see this was actually last week Friday's candle. So this is last week Friday's candle here. So these candles were not formed then when we actually analyzed the market, when I told us we should expect price to pull back to the downside first before we determine the bullish move. And we could consider price dipping lower to this particular buy side liquidity level, to dip lower below that before we see the buy move. Why was I anticipating the push of price to the downside to this level? It is actually because of this candle here. This is where we actually have the last buy move before the sell move to the downside. So I expected to see that price would actually dip lower to actually mitigate this particular zone, because we can consider this more of like a mitigation block. So, and you can see that this is the last sell move before the buy move. So we expect to see price return to mitigate this particular order flow before we see the bullish push of price to the upside. But what you will see on Monday is that price returned to the downside. This is actually Monday's candle. Price returned to the downside, but did not dip lower into this buy side liquidity to actually mitigate this order flow before we have the buy move. So now the question this particular subscriber is actually asking and wanting to understand is how he would have actually framed his entry since price did not dip lower to actually mitigate this order flow on Monday, and then you can see on Tuesday price continue movement to the upside. So this is what we are going to actually look at in this review. So now you can see that price did not dip lower to mitigate this order flow in the daily time frame on Monday, because this is Monday candle. This particular candle here, the bearish colored candle, is Monday candle. Price did not dip lower to actually mitigate the order flow. So let's drop to the 4-hour time frame to look at things from more minimal perspective. So this zone may reclaim price to the downside, and then we could see price possibly fall further into this fair value gap, which is in confluence with this order block that was violated to the upside. So we could see price dip to the downside, and then we see price push further to the upside. So what you can see on Thursday, in confluence to why I was actually expecting to see price dip to the downside, you would see that here we have this particular order block that was violated to the upside. So let's mark out that order block, this particular order block that we see here. What we can see is that price actually created the order block. When price mitigated this rejection block, took out the liquidity resting here, and then price gave us the bearish move to the downside, but then price returned and then broke through this order block. So I expected to see that price will reclaim this particular zone. Price will come to the downside and mitigate this order block that was violated. So you can see when you check in confluence to the daily time frame here, where we have this particular order flow to the downside, what you can see is that we have that order block that was violated in the 4-hour time frame is also in confluence to this order flow zone here. That was why I expected to see price will dip more lower. Let's actually make this horizontal line to actually appear in the hourly time frame. Then we actually go to the 4-hour time frame. So you can see that in the 4-hour time frame is actually this zone where we have this range. So we have a rally, we have a base, and then we have the drop. And then price breached through this consolidation here. Price returned into the consolidation. But you see that price returned into the consolidation on Thursday. So what happened on Monday is now you can see we have this movement to the upside here is actually Friday's movement, this bullish candle and this other bullish candle and this other bullish candle. So we have Sunday giving us the bearish move to the downside, and this is Monday. So price dip lower, and then you can see that price is not dip lower to mitigate this consolidation, and then price pushed to the upside on Monday. So how would Europe actually utilize the return of price to the downside to frame the bullish move to the upside? So what you can see based on the 4-hour time frame is when price returned to the downside, what you can see is that price did not dip lower. Price gave this rejection to the upside. And then the next you would see price gave us this bullish engulfing candle. So this is actually signaling to you that the buyers are actually intending to push the markets to the upside. Because what you can see is price created this order block here. Price gave the movement to the downside. And then we now see that price created this other order block here. We can see we have this engulfing candle because this is a bullish candle. It engulfed the body of this bearish candle. So you could take your entry at the close, and you can see that now price actually pushed to the upside. So now this was what happened on Monday. So when you actually drop to a lower time frame, to a far lower time frame during the week, which is actually the 1-hour time frame and I think the 15-minute time frame, you're going to see that within this particular week, we have the order block that help us to determine the return of price, even if price did not return on Monday to mitigate this consolidation. So what you can see is this is the 1-hour time frame. So you can see we have this particular sell move before this buy move. So price created this order block, price created this order flow before the bullish move. Because you can see price took out the low of this bullish candle and then sponsored this move to the upside. So this is actually a zone where price will actually want to mitigate this order block. And that is what you can see price did. Price returned to this order block, mitigated the order block. Because what we can see here is this. Price gave the impulsive move that took out this buy side liquidity. And then what you can see is price created this fair value gap here between this candle high point and this candle low point, and then price returned into the fair value gap and give the rejection. So this order block should reclaim price and then push price further to the upside, and that is what you can see happen here. So when we check the 15-minute time frame, we are going to see from the 15-minute time frame is that you can see what we have in the 15-minute time frame. Price returned to the downside after breaching the buy side liquidity. Now what you can see we have is that we have price gave us the impulsive move. Price gave this pullback. Price pushed to the upside. Price return took out the sell side liquidity, and then price mitigated the fair value gap and gave the impulsive move. So you can see this impulsive move was even on Friday that happened, You can see now on Sunday was giving the bearish movement to the downside. So we're expecting to see further push of price to the downside, where price would come and mitigate this order block, because this is the last sell candle before the bullish move. Price took out sell side liquidity, fill up the fair value gap, the inefficiency, and then price pushed to the upside. So we should expect the return of price for price to mitigate the sponsorship candle within this movement to the downside that took out the sell side liquidity and then fill inefficiency. So you can see then price pushed to the upside. But then the movement that happened on Monday, Tuesday, and Wednesday did not invalidate the fact that price should actually return to actually mitigate this order block. So we can consider this as a breaker, because you can see this took out this buy side liquidity, dropped to the downside, and then price now returned and violated it. And then you can see that price still returned to it on Thursday, and then we're having the bullish move of price to the upside. So this is how you would have actually utilized this particular trade forecast that we actually made available last week in the YouTube channel for you to actually execute your entry even from Monday when the market opened, because you can see that some people actually witnessed this bullish move but did not actually execute their buyers, their buy movements, because they were expecting to see that price return to the zone we called out. So you must understand that the market will do whatever the market wants to do. So it's for you to actually utilize what you understand about price delivery. It's for you to actually see what the market is revealing at the particular moment you actually sit before your chart. So you can see that now in the 15-minute time frame, vividly, you can see that is what we have. We have actually the reason to actually buy on Monday without really expecting price to return into the zone. Because you can see we have that impulsive move that took out the buy side liquidity. Price created inefficiency. Price created the sell side liquidity. Price return took out the sell side liquidity, filled the inefficiency, and we have the impulsive move. So we should expect price to return, to be reclaimed by this sell move before the bullish move, this order block. And then we can see that now price traded to the upside. So because you can see that now, we can actually look at this as an order flow. But it is the sell move before the buy move. So return of price to mitigate the order flow and any form of sponsorship candle within the order flow. And then you can see we have this bullish push of price to the upside. So this is just a very quick review. I won't really check out the other PS, but I believe with this, you can actually utilize some of this things I'm making known to you guys, and then you can be able to analyze the market and actually interpret price delivery whenever the market's open, even when you don't see price returning to the zone we call out during the weekly forecast. But you must understand that the direction you've established is actually what you actually want to trade with, but then you must be very flexible to also understand the delivery of price if there is a change in the direction of bias. So guys, this is all I have to show us. So cheers and God bless you all.